This is supply and this is demand. And this is a supply and demand indicator that we can use to identify and plot the supply and demand zones. Supply and demand is probably one of the most essential aspects of trading with price action. It can predict whether the price will rise or fall, gain momentum or lose momentum. If you really need to maximize your price action trading potential, you need to understand supply and demand because of how well it works. In this video, I'm going to show you how to draw supply and demand zones correctly and how to enter and exit your trades. Most importantly, we'll also show you this awesome tool that we can use to automatically identify and plot the supply and demand zones. If you end up finding this video helpful, remember to leave a like. Let's get into it. So what exactly is supply and what is demand? Well, supply is an area where the currency pair was historically unable to go above, indicating a point where the currency was perceived as overvalued. Sellers stepped in at these levels, creating a downward pressure on the price. A supply zone can signal potential selling opportunities in the future if the price revisits that area. Traders expect that the large sell orders responsible for the previous downward movement might still be present, leading to another price decline. On the other hand, demand is an area where the currency pair was historically unable to go below, representing a level where the currency pair was perceived as a good value or underpriced. A demand zone can signal potential buying opportunities in the future if the price revisits that level. Traders expect that the large buy orders responsible for the previous upward movement might still be present, leading to another jump in price. So how do we draw a supply or a demand zone? Well, let's begin with a demand zone on a naked chart. As we can see here, the price was consolidating while moving downwards slowly. It looked like a downtrend, but it also seemed like a consolidation. Then all of a sudden, the price made a big aggressive move to the upside. So what happened at this point? Well, there must have been a level of demand right here, meaning a huge number of buy orders. To identify that demand zone, you basically identify the very last bearish or red candle that was printed before the big bullish move, which is this one right here. Take your rectangle tool and draw from the high of that candle to the low of the candle, from the upper wick to the lower wick of that candle. This is your demand zone. So the idea is that if the price ever returns to this zone in the future, you'd look to enter a long position right here, set your stop loss below the zone, and set your take profit somewhere above at a key level. We let the trade run and take profit. Now the opposite is true for a supply zone because supply is the opposite of demand. Let's take a look at an example. The price moved down aggressively after this bullish move. Identify the last bullish candle that was printed before this bearish move. This is the candle you focus on. Draw from its low to its high. This is the supply zone. In the future, if the price ever returns to this zone and bounces off it, this is where you would enter your short position. Your stop loss goes above the zone, and your take profit is going to be set at the next key level. That, my friends, is how you identify supply and demand zones. At this point, you might be thinking that this process can be a bit complicated. I think the same too. If you can do it manually, good for you. But if you don't want to stare at your charts every single day waiting for those supply and demand zones, you might want to use an indicator. An indicator called...
What the f*** is that?
This is the name of that indicator. Let's just call it supply and demand indicator. This indicator was created by JP7FX in February of 2022. To add it to your chart, open the indicator search tab and type in supply and demand. Select this one by JP7FX. This indicator was designed to identify and display the supply and demand zones on multiple timeframes on your chart. Now, before we explore this indicator's components, let's talk about our channel sponsor who helped make these videos possible. hankotrade. hankotrade is one of the most reliable forex brokers out there. I personally use them on a daily basis. As you can see here, this is my trading history. I mainly scalp gold, and up here you can see that this is actually a live account. The reason why I love hankotrade so much is because of their extremely low commissions and spreads. On Forex, for example, the spreads can go as low as 0.0 pips, which is actually the lowest it can go. For those of you that love high leverage, hankotrade offers a maximum leverage of 1 to 500. If that's not enough, they're also going to give you a 100% bonus for all your deposits up to $25,000. So if you deposit, say, $25,000, they're going to give you a bonus of $25,000. So now you'll have a total of $50,000 to trade with. To access the bonus as well as all the other perks, sign up to hankotrade using the link in the video description. Now, back to the video. Now, after adding this indicator to our chart, we can see several different zones. It's a supply and demand indicator, so the question is, which of these zones represent demand zones and which ones represent supply? Well, the green zones are the demand zones. Let's take a look at this one. Each demand zone has a green background fill, a purple line at the top, a pink line at the bottom, and a green dotted line in the center, which is called the 50% line. This 50% line is where you'd look to enter your trades. The red zones, on the other hand, represent supply. These zones have a red background fill, then there is a pink line at the top, a purple line at the bottom, and the same green dotted 50% line in the center. Just like with the demand zones, the 50% line in the supply zones is where you'd look to enter your trades. Speaking of entering trades, how would you enter a long trade with this indicator? Well, the simplest way is like this. To take a long trade, you basically wait for a demand zone to be printed on your chart like this. After the zone is printed, you want to wait for the price to come back to the zone. As it approaches the zone, you want to place a buy limit order at the 50% line. Put your stop loss right below the demand zone. And for the take profit, you could have a fixed value take profit like 3 times the risk or 5 times the risk. Or you could target the next key level in price, which could be an area of support or resistance, or an area of supply or demand. For short trades, it's going to be the opposite. So, you first of all want to wait for a supply zone to be printed. After the zone is printed, you want to wait for the price to come back to the zone. As it approaches the zone, you want to set a sell limit order at the 50% line. Put your stop loss above the zone, and for the take profit, you could again set a fixed take profit value, or you could target the next key level in price. Now, looking at the settings of this indicator, we can see tons of customizable options. Things like the maximum supply and demand lines on the chart. We can also change the supply and demand line style and the supply and demand line width. We can change the line style of the 50% line, the width of the 50% line, and all these settings. But the most important thing about this indicator is the fact that you can have it display the supply and demand zones of a time frame that is different from that of your chart. So for example, if you are on a 5-minute time frame, the settings for that time frame are going to be under chart time frame. Now, if you need to have any other time frame, let's say you want to see the supply and demand zones of the 1-hour time frame while still being on the 5-minute time frame, you simply come here under time frame 2, and right here you will be able to select any time frame that you want. It could be a higher time frame or a lower time frame. The indicator will be able to plot the supply and demand zones for that time frame without needing to switch to a different time frame. So for this video, we could go with the 1-hour time frame. And as you can see here, there's going to be this label that says 1 hour. So these other 5-minute time frame labels right here are for the chart time frame because the chart is set to the 5-minute time frame. But whenever you see 1 hour, this basically represents supply and demand zones that the indicator identified on the 1-hour time frame. And now we can be able to take trades on lower time frames based on higher time frame supply and demand zones. For the strategy we're going to showcase in this video, we're going to leave all the settings at the default values. So click cancel. Now let's add 2 more indicators to the chart to craft our strategy around this indicator. On the indicator search tab, type in breakout finder. Select this one by Lonesome the Blue. Next, type in EMA. Select this one right here. Double-click on the EMA to access the settings panel. On the Inputs tab, change the length to 100. And on the Style tab, change the plot color to white. Now, as you can see here, we've added 2 indicators, and one specific question must now be asked. What is the purpose of each of these 2 indicators we've just added? Well, let's start with the EMA. This indicator is a trend confirmation tool. We're going to be using it in this strategy to ensure that we're only going to be taking supply and demand trades that align with the market's overall trend. And I think you already know how we're going to do that. When a price is constantly trading above the moving average, that indicates a bullish trend. On the other hand, when it's constantly trading below the moving average, that indicates a bearish trend. Now, what about the breakout finder indicator? What are we going to use it for? Well, as the name suggests, this indicator identifies breakouts in the market, both bullish and bearish. You see, the thing with supply and demand trades is that they can be super profitable if combined with a break of structure. Here is what I mean. When you're looking to take a long trade based off of a demand zone, you naturally want a demand zone to be established and for the price to shoot up aggressively, solidifying that area as a demand zone. But what would make that demand zone even better is if on its way upwards, the price encounters a key market structure like a resistance zone and then breaks above it. The significance of this is that when the price later on comes back down to retest the demand zone, the majority of the traders will be focused on the resistance level and will be entering their trades based on a break and retest of that resistance level. They'd see that the price broke that resistance level and is now doing a retest. When most traders enter their trades here and set their stop losses below, the price will often do a fake out, taking out all their stop losses and descending to your demand zone. And that is where we enter our trade. And of course, it's going to be the opposite for short trades. Now, to show you what I mean by this, let's take a look at how we could enter a long position. Now, to enter a long trade, these are the conditions. First, we want the market to print a demand zone within a bullish trend. To confirm that, we just let the market play out until a demand zone is printed. This zone right here represents a demand zone. Now, to make sure that the market is in a bullish trend, we just make sure that the price is trading above this 100 period EMA at the time the demand zone is printed. And for the EMA itself, we need it to be angled upwards like this and not just flat. Now, after we have a demand zone within a bullish trend, the next thing we want to have on our chart is for the price to break above a key level, also known as a break of structure. To confirm that, we're just going to activate our breakout finder indicator by clicking right here. And as you can see here, there is this blue upward arrow, which indicates that the price broke and closed above this key level, which is basically a previous resistance level indicated by this blue rectangle. Now, looking closely at this, you can see that this is the candle where our demand zone got established. And right after the demand zone got established, the price started pushing upwards aggressively and broke above this previous resistance level. This is what we're looking for, a demand zone to be established first, then followed by a break of structure. The break of structure doesn't have to come immediately on the next candle. It can be 3 candles later. It could be 4 candles later, but up to a maximum of 10 candles later. 10 candles after the establishment of the demand zone. Now, after we have our demand zone and the break of structure, we then wait for the price to come back down to the demand zone. Before it gets to the demand zone, we want to have a buy limit order at this green dotted line, also known as the 50% line. We don't want to have it up here or down here. We want to have it at the optimal price, which is the 50% line. We're going to set our stop loss below the most recent swing low, or you can even set it just below the demand zone if the swing low is too far down. But for this particular trade, we have this beautiful key level right here, so we're going to set it right at that key level. And as you can see, this is a really good risk to reward ratio. Now, we're going to let the market play out. As you can see, that trade was super profitable. Now, to enter a short trade, these are the conditions. First, we want the market to print a supply zone within a bearish trend. To confirm that, we just let the market play out until a supply zone is printed. This zone right here represents a supply zone. Now, to make sure that the market is in a bearish trend, we just make sure that the price is trading below this 100 period EMA at the time the supply zone is printed. And for the EMA itself, we need it to be angled downwards like this. Now, after we have a supply zone within a bearish trend, the next thing we want to have on our chart is for the price to break below a key level, also known as a break of structure. To confirm that, we're just going to activate our breakout finder indicator by clicking right here. There is this red downward arrow which indicates that the price broke and closed below this key level, which is basically a previous support level indicated by this red rectangle. Now, looking closely at this, you can see that this is the candle where our supply zone got established. And right after the supply zone got established, the price started pushing down aggressively and broke below this previous support level. This is what we're looking for. A supply zone to be established first, then followed by a break of structure. Again, the break of structure doesn't need to come immediately on the next candle. It could come 3 candles later or 4 candles later, but up to a maximum of 10 candles later. 10 candles after the establishment of the supply zone. Now, after we have our supply zone and break of structure, we then wait for the price to climb back up to the supply zone. Before it gets to the supply zone, we want to have a sell limit order at this dotted line. We're going to set our stop loss above the most recent swing high. For the take profit, we have this beautiful key level right here, so we're going to set it right at that key level. And as you can see, this is a really good risk to reward ratio. Now we're going to let the market play out and see what happens. As you can see, that trade was super profitable. In conclusion, this indicator provides a powerful tool for traders seeking to leverage supply and demand dynamics in conjunction with market trends. By offering the ability to view different timeframes at the same time and integrate it with other indicators, it maximizes efficiency and accuracy in trading decisions. That's been it for this video. I hope you found some value. If you did, hit the like button below and consider subscribing to stay tuned. Thanks for watching. See you next time.